Today I want to share about inflation, whereby in recent inflation data started cooling, but the job markets also softened as well. So and the Federal Reserve holding back. Okay, now the U.S. economy in mid 2025 present a curious mix. Inflation is falling, hiring is slowing, yet the Federal Reserve is keeping interest rate unchanged. Okay, so basically the Federal Reserve, right? It had, like I said, it has a dual mandate, and these are the mandates they are dealing with. Okay, it's the jobs and dealing with the prices, i.e., inflation and so on, right? So at the same time, new global tariffs and geopolitical tensions could soon reverse some of the progress made. Here's a clear breakdown of the most important developments. Okay, so first of all, inflation is cooling, but will it stay that way? Now, the May CPI showed annual inflation at 2.4%, while core inflation, which excludes food and energy, was steady at 2.8%. Now, on the surface, that looks promising. Inflation has clearly slowed from its 2022 to 2023 highs, and headline price increases are now close to the Fed's 2%. Now, businesses have so far absorbed higher import costs instead of raising prices, and cheaper gasoline help ease pressure, right? Now, however, this trend may be temporary. New broad-based import tariffs introduced by President Trump are only just beginning to take effect. Now, many companies stock up goods before the tariffs were implemented, thus keeping price low for now. But as inventory run out, higher costs are expected to pass through to consumers. Big retailers like Walmart have already warned that price hikes are coming, right? Meanwhile, energy markets remain fragile. Should tension escalates further between Israel and Iran or disrupt oil exports, fuel and electricity prices could surge. Now, this is a very real situation and it's already happening right now. Okay, do remember that Trump's fight against inflation, right, hinges upon low energy prices, and the skirmish between Iran is not going to help his agenda at all. So while inflation appears under control, the Fed remains alert. Officials believe there's a real risk it could re-accelerate in late 2025 as tariff and global disruption feed into prices. Okay, so that's the inflation front. On the labor front, we are seeing labor market softening. It's a normalization or a warning sign. That is the question mark, right? So job growth in May came in at 139,000. A key sign of labor softening is that prior job numbers for March and April were revised down by 95,000. So they show six-digit increment right here. But the previous months, they are actually bringing it lower, and we are talking an amount close to six figures as well over here. Okay, so what does this mean? This is like overstating, and that's really, really a lot, right? Unemployment held at 4.2%, but the slowdown in hiring suggests the labor market is cooling. And you can see from here, manufacturing lost jobs partly due to declining exports and rising input costs. Government hiring slowed too, with federal job cuts outweighing state and local gains. And you can see after the COVID hire, the boom in the hiring, after that, we are seeing a sustained downtrend happening in the jobs market. That's why I said that the job market is what you call cooling. softening at the current moment, and you can see that it is going down and down and down and down. Okay, so still many economists interpret this not as a crash but a long expected cool down. After the explosive job rebound from the pandemic, the economy is adjusting to a slower, steadier rhythm. Now, wages are growing at 3.9% annually, faster than inflation, which is a positive sign for household, and job losses remain limited to specific sectors while healthcare and hospitality continue hiring. That said, not all signs are reassuring. Labor force participation fell in May, suggesting some workers are exiting the jobs market. Now, temporary hiring, often a leading indicator, is also weakening. This could point to a more fragile labor environment than headline figures suggest. Now, overall, the current labor market softening appears to be controlled cool down, not a collapse. It aligns with a typical post-tightening cycle whereby growth slows and job markets loosens a bit after a period of rapid gains. Now, this easing can actually extend to economic expansion by preventing overheating. However, it's a fine line to walk. If something jars the economy, something really, really hits the economy, the slowdown could accelerate into a downturn. Okay? Now, as for the Fed, it is holding rates steady. And here's why. So with inflation receding and the labor market losing some momentum, many beginners might wonder, why hasn't the Fed started cutting interest rates? Typically, the Fed raises rates to fight high inflation and cut rates to stimulate growth when inflation is low. Now that inflation has fallen close to the Fed's 2% goal and hiring has slowed, one might expect rate cuts to follow. In fact, President Trump has loudly called for the Fed to slash rates, even urging a full percentage point cut in light of the great inflation news. And this morning he reiterated the call again. Okay, but despite this pressure, the Fed has so far held its benchmark rate steady in 2025 and signaled a cautious stance. Fed Chair Jerome Powell and his colleagues have several good reasons for delaying rate cuts reduction at this stage. The first is tariff inflation risk. The Fed expects prices to rise again later this year as tariffs filter into supply chains. Core inflation is still sticky. Now, the Fed don't just look at inflation. They want to minus out the volatile part of it, like food and energy. And that is still 0.8% away from the Fed's goal, right? Now, there are also lessons of the past to learn. In the 1970s, premature easing reignited inflation. So the Fed is determined not to repeat that mistake because it will look back on them. But I think one of the most important things among all is this, what we call lag effect. Interest rates hikes take time to work. The full cooling effects may still be playing out in the economy. Okay, the previous hikes, all this inflation, just they have to wait a bit. Okay, so far. Now, there's also this geopolitical uncertainty, ongoing wars in Ukraine and Gaza, and the risk of escalation in the Middle East could affect commodity prices and trade, thus adding fresh uncertainty to the inflation outlook. Okay, so political pressures as well. Trump has publicly demanded a 1% rate cut. The Fed is resisting political interference, keen to maintain its independence and credibility. Now, Fed Chair Jerome Powell has repeatedly emphasized a data-dependent and wait-and-see approach. Officials are willing to cut, but only when they are confident inflation is on a sustained path down and not just taking a pause, right? So lastly, I think the most important thing to talk about is Trump's global tariffs. Will they add to inflation? Now, a big economic debate in 2025 revolves around President Trump sweeping new tariffs and whether these tariffs will cause higher inflation. Now, let's revisit this again. Tariff raise the cost of imported goods by percentage of tariffs, For example, 10% on electronics means importers have to pay 10% more to bring those items in. Now, in the very short run, companies have a few ways to respond. They might accept lower profit margins, switch suppliers, or raise prices for consumers. Often you see a combination of this, but a significant portion of the cost does get passed on to consumers as higher prices. Now, history supports this. During Trump's first term, when tariffs were placed on imported washing machines, consumers quickly saw price hikes. Okay. Now, this is a bit different, I have to say. Okay. In his first, what do you call, during his first presidentship, right? These tariffs were not, is not, it's only to selected countries, right? The current situation is broader. Trump's global reciprocal tariffs cover nearly everything the US imports from other countries at a minimum rate of 10%. Okay, that makes it hard for business to avoid tariffs by switching suppliers. It's not going to be, there's no way around it. This time, Trump made sure it's going to be really broad. Now, initially, many companies stockpile inventories before the tariffs took effect, buying goods at old prices. That's why, as of May, inflation data didn't show a huge jump. Most retailers were still selling off pre-tariff stocks, and a few categories like appliances and toys saw noticeable price upticks already. Those that have already sold everything, then most of their stocks, then that they have already seen price moving up. So anyway, as for the rest, this won't last. As inventories run out, businesses will face higher replacement costs and begin passing them on to consumers. This is why the Fed is concerned. Officials worry tariffs could reverse progress on inflation by causing a one-time jump in price levels for many goods. The key question is whether that one-time adjustment or something that spirals. Okay, it is either, is it a one-time adjustment? This is the key concern, or something that spirals. We don't know. The Fed doesn't know. For now, the Fed assumes it will be mostly a one-time oil price increase, but they remain cautious because early in the decade, they underestimated inflation's persistence. In the long run, tariffs inflation impact depends on how the broader economy reacts. Tariffs don't occur in a vacuum. They tend to slow economic growth by raising costs, straining businesses, and reducing trade. So if consumers are paying more for tariff goods, they may cut back elsewhere. Okay? Higher prices can dampen demand, putting downward pressure on inflation over time. Now, in this way, tariffs can act like a tax that cools off the economy. People and companies have less purchasing power, which might lead to slower growth and potential lower inflation after the initial price bump. Now, some economists argue that tariffs aren't inflationary in the long term and could even be deflationary if they weaken the economy significantly. The Trump administration argues that tariffs will lead to a stronger domestic economy with more production at home, which they claim will produce plentiful jobs and lower inflation in the future. Most economists are skeptical. History shows protectionist policies often make price higher, not lower. Now, another concern is expectations. If businesses and consumers start expecting inflation to rise continuously due to tariffs, they can become a self-fulfilling cycle. Higher expected prices lead to higher wages and more price hikes. The Fed is very careful to prevent this mindset from taking hold. So the big question is, so do tariffs cause inflation? In the short run, yes. They raise prices for a wide range of products, especially once pre-tariff inventories are used up. In the longer run, right, their impact depends on how much they slow the economy and whether they change behavior. Now, this is that big question mark. So if demand falls or supply chains adapt, inflation pressure might ease. But in the meantime, households will likely feel the pinch in their wallets because that's the short term. thing. Okay, so that's why with this kind of questions lingering, the Fed is not willing to take that step because they don't know how much inventory all these companies are holding before it finishes. And when that finishes, then, of course, companies, if they can stomach, but how long? Even if the companies was to stomach this tariffs, right, it's going to show on their balance sheet, and that is going to affect the stock market as well. Okay, so Trump's plan to bring manufacturing back, that's not going to be easy. Manufacturing also involves the workforce and setting up plants will take time. It will be cost as well. Capital expenditure will increase, and that also stifles innovation because money is being used for huge capex. Building factories are huge capex, right? And all these will reflect. So, based on these developments, it's not going to be easy for US in the short term. That's why I said prices are going to increase, and if all this were to persist, right, can the stock market continue to go higher and higher? I'm doubtful, especially if profits start to fall, okay, in the medium term for the companies while they spend money for all these need, to keep up with the regulations, the Trump regulations. Do take you have to understand that Trump just came in. He still have a long time in his presidency before his presidency ends. So this a lot if the companies comply with all this his demands, yeah, we could see profit dampening for the short term, and that will bring the stock market down as well. Okay, in the short term. So with that, hopefully you understand the developments, and that's the report for today.